Well, I was just going to wait till 3:30, which we're
okay.
away from.
All right.
And then I'll turn it over to you and the director. So.
All right. Okay. Great.
So I see it as 3:30, Madam Director. I think for the record, we have the secretary, the auditor, the treasurer, myself. I do not see the superintendent, but we do have a quorum. And so with that, Mr. Treasurer, if these are your measures, please go ahead.
Yeah, thank you, Mr. Chairman. Mr. Chairman, I guess our first manager up is KKR, and you're going to have a discussion on that with both Josh and do I see? I'm trying to find. I don't see Caleb. I think Caleb was going to work on this one, right, Josh? Is that what you recall?
And for the record, Madam Director, I see the superintendent has joined us. So.
Okay. So, Mr. Chairman, I don't see Caleb there, but Josh, why don't you start on the process?
Mr. Treasurer.
Yeah.
I believe Patrick was just going to have Mr. Keevan speak to the manager.
Oh, he was just going to speak to the on that one. Okay, thanks. Thanks, Caleb. All right, you're on, Josh.
Great, thank you, Treasurer, Governor, members of the Slib board, Josh Keevan with RVK. Is it correct that KKR will be presenting first?
That's what I have in my book.
Okay. Great. So I'll just speak at a high level here to introduce the process and the recommendation. I'll reference our memo, which I know we've had the chance to review with most of the Slib board, but we are recommending the addition of KKR to your bank loan portfolio as a new manager based on a very thorough analysis of the broad universe of candidates. This was done collaboratively with the State Treasurer's Investment Office, and ultimately some of the distinguishing features that we found particularly attractive here were, number one, consistency of alpha production, so consistent record of outperformance. Number two, perceived a very good fit with your existing managers. As you'll note in our recommendation memo, a correlation of excess returns with your existing managers that's practically zero over both longer time periods as well as more recent time periods. So we believe their addition will help to improve the diversification and the overall structure of the bank loan portfolio. So Mr. Treasurer or Mr. Chairman, other members of the board, happy to take any questions now or simply turn it over to KKR.
Mr. Treasurer, do you think there's any questions? I guess I'd ask you, the superintendent or secretary, if there, or the auditor, if there are any questions.
Mr. Chairman, I don't have any. I think that Josh explained the way that KKR is going to fit in with our other bank loan managers, and I think they complement each other very well. So I would just turn it over to KKR, and if that's fine with you.
Perfect.
Well, Treasurer Meyer, thank you very much for that tee up, and Josh, thank you as well. Governor Gordon and other distinguished members of the State Loan and Investment Board, staff, and other members of RVK. My name is Dan McLaughlin. I'm a managing director at KKR. have been on the relationship management side of the business for the last 12 years at the firm, and spending time in Cheyenne for almost 20 years now. So the opportunity to potentially partner with the state of Wyoming and the Wyoming Permanent Funds, very exciting to myself and the group of individuals that are joining me today, as well as the firm. I think we've got a great team here that's going to do a quick run through on exactly how we would describe our distinguishing factors, and then are happy to answer any questions. As part of that, my colleague is happy to screen share the short presentation we provided, or we can just point to the pages as we go. But again, the team joining me today, Andrew Clerico. Andrew, you might want to give a quick wave there because we're all Andrew on the screen. And he's been at the firm now for almost 5 years. We've worked together throughout that time. He's been focused entirely on our credit business for that 5 years and for his entire career. If we were lucky enough to be selected, he would be the individual responsible with myself and Jeremiah Lane, who Jeremiah, there you go, partner at the firm. Jeremiah is directly responsible for the bank loan strategy at KKR, has been at the firm now for over 15 years and really around since the origination of our credit business. This would be your primary team. But in addition to that, obviously, you would be getting the full resources of a 45-year-old global investment management firm. And with that, I'm just going to turn it over to Andrew for a couple of quick comments on our bank loan strategy, and then we'll hand it over to Jeremiah.
Yeah, thanks, Dan. I appreciate that, and thanks everybody for having us present. To echo Dan's point, it's an honor to present to you today. As Dan mentioned, my name is Andrew Clerico. I'm the credit specialist for the relationship. So as far as RBK or the team at Wyoming, I would be your point person here. Just briefly from the presentation, page 7. I'm not going to touch on all of the points here on the page, but just some of the highlights that I think are worth noting. Number one, KKR Credit. We've been in business since 2004. We've managed dedicated pools of bank loan assets, GIPS compliant since 2011. Today, we manage roughly $15 billion in dedicated bank loan assets. Of that, roughly $2 billion, a little over $2 billion, is in separately managed accounts, institutional limited partners. And so with the addition, if Wyoming was to engage with us in a partnership, it would be a meaningful addition to our business. And, certainly we would treat it as such. Just briefly, we are fundamentally driven investors with everything that we do. The process has been in place since the beginning of the credit business, which Jeremiah could get into. And we have 40 analysts, dedicated analysts on Jeremiah's team that are helping source ideas and execute the strategy. And really, since the beginning of the dedicated bank loan track record, we've been top quartile performer relative to our peers. And so with that, Jeremiah, I'll turn it over to you to talk more depth of the strategy.
Terrific. Thank you, Andrew, and thank you for having us present to the committee. I'll take you back to page 5. I'm going to spend about 10 minutes, and then we'll have some time at the end for questions. We started, KKR is known to all as originally a private equity firm. Credit was actually the second business that we started. So we expanded out of private equity into credit in 2004. I joined a few months after the business was founded. I joined in 2005. And I think there's one key point to make around the start of credit. Different than many of our peers, many of the large asset managers that we compete with. When we started our second product, we opted for what we call the one firm approach, which is a deep integration across all of our different business lines. And that integration extends to compensation, it extends to due diligence, it extends to sharing of relationships. And that's a critical difference between the approach that we take and many of our competitors take. And we think it's a really material advantage for us in terms of our ability to assess businesses, assess industries, management teams, private equity owners of assets. And as we diligence opportunities for potentially for your portfolio and for all of the other portfolios that we manage, we're consistently tapping into the knowledge that sits within the firm in order to come up with differentiated points of view, risks that we want to lean into and risks that we don't want to lean into. If you jump to the next page, I'll just take a little bit closer look at leverage credit. Leverage credit is the performing traded business. This is what we started with in 2004. It's still our biggest business in credit. Of 170 billion in credit overall, 100 billion is in our leverage credit business. It's the part of the business that I have focused on the entire time that I've been here. I've always been based in San Francisco, always working on performing traded. We have a number of different strategies. I think really the takeaway from the bottom is we do well in a lot of different things. But the bank loan composite there on the left side of the bottom shows our long-term performance in bank loans. Over more than 10 years now, we've shown a really nice outperformance versus our benchmark. And that's outperformance on both a gross and a net basis. Andrew touched on some of the points on page 7, so I won't rehash them. The things that I want to really underscore are that we have a fundamental underwrite approach. Everything that we're putting into any of the portfolios that we're managing really passes our assessment of durability of cash flow and downside protection. And that's our North Star when we start to analyze any new credit. I think that one of the things that has made us particularly successful is our team structure. And I really think of there being as 4 key elements of our team structure. We're industry specialists first. So those 40 analysts that Andrew described that report into me and the other leaders of the business, they're all aligned by industry. They're tasked with coming up with what we call frameworks, consistent approaches to investing in their space, the parts of their space that we think are going to be successful and durable and grow over time, in the parts of their space that we want to avoid. And then they're tasked with looking at everything and consistently applying that framework. One of the things that I'm going to keep hitting on is consistent application of our approach, because that's critical for repeatability of outcomes, and it's repeatability of outcomes that's allowed us to outperform in the short term and also over the long term. So number 1, we're industry specialists. Number 2, our analysts look at a very, very broad spectrum of risk. We think that that's critical. You develop a better nose for value if you look at things that are not doing that well as things that are doing well. Ultimately, everything that's going to go into your portfolio is going to be something that we think is going to survive and thrive. It's going to have those characteristics around durability of cash flow, downside protection. But the analyst is going to be sharper in their assessment if they look at things that are succeeding as well as things that are failing. And that's core to how we've developed our model. Second, our analysts don't only look at bank loans, and we think that that's critical. There is knowledge to be gleaned about your industry by looking at high yield bonds, converts, other asset classes, and learning your industry more deeply by having a broad spectrum of things that you assess. And then finally, what I described at the outset, that one firm approach. Our analysts are tapping into the knowledge base that sits within the broader KKR organization to come up with differentiated perspectives on their company. Sometimes that's going to be accessing our private equity professionals who may have assessed the business or may have owned a competitor. Sometimes it's going to be accessing a private credit originator who has a relationship that you can leverage to get a differentiated allocation or get a differentiated access to management. Sometimes it's going to be accessing our workout team. On the private side, we have a group of workout specialists. These workout specialists have been instrumental in a couple of occasions where we made mistakes in delivering starkly better outcomes than the market overall. We had a circumstance in the last year where we will ultimately get par recovery on an asset that went through bankruptcy as a result of the work that our workout specialists did. Other lenders who did not have the benefit of those workout specialists will recover between 30 and 40 cents on the dollar. Really, really differentiated outcome. So those are the four key elements: industry specialization, broad spectrum of risk, looking across asset classes, and with the benefit of the one firm approach. Finally, the last point that I would just make is that we have a highly structured process. I'll get to this in a couple pages, but we have meetings on the calendar daily, weekly, monthly, quarterly, in order to both underwrite and re-underwrite the businesses that we're invested in. And we have all of that process in place, again, to try to drive repeatability. If you go to page 8, I'm not going to touch on all of the elements here. The couple of things that I want to highlight, the broad investment universe. Typically in a bank loan mandate, there are going to be between probably 250 and 350 issuers. We're drawing those issuers from a universe of 1,300 issuers. And we're looking at a broad spectrum of assets and companies to distill it down to the ones that we believe have that durability of cash flow and downside protection that merit inclusion in the portfolio. The other one that I really want to call out here is the alignment between staff and strategy. A big part of KKR's approach to everything we do is eating our own cooking. With our large balance sheet, we are the largest investor in most of the asset classes where we manage assets. In total, KKR balance sheet has $2.8 billion invested in credit strategies. Just focused on bank loans, we express our conviction in our bank loan strategy by investing in the equity of our CLOs, which are portfolios of bank loans that we manage, where we have $500 million initial face value invested. We are big believers in our approach, and we demonstrate that by committing our dollars. On page 9, we have an overview of our team. We have a big team. I work very closely with the three other folks across the top of the page. Chris Sheldon, who was one of the initial founders of the credit business at its inception. John Reed, who's worked closely with the two of us for 13 years since he joined in 2008. And Terry, who spent the bulk of his career actually at PIMCO and joined us a couple of years ago. And we're the senior leadership team of the U.S. leverage credit business. And then we have a large team of analysts that support us and generate ideas. On page 10, we've included some more detail around our process. So here we've listed out all of those meetings that I was describing. The daily morning meeting is where analysts are reading out critical news in their space. Weekly prioritization meeting is where Terry and I are directing analysts to focus their time, their energy on underwriting businesses that we think are going to be good fits for our overall strategies. If you skip down, you can see the IC near the bottom of the page, the IC meetings, the office hours. We have 4 of these per week of different levels of formality where we can spend 30 minutes to an hour talking through a business, talking through the management team, the owners of the business, to get a sense of whether or not it's a fit for our approach. And then finally, the PMC process, that's short for Portfolio Management Committee. This is our quarterly re-underwrite. This is how we stay close to the businesses that we're invested in and make sure that they're continuing to have those characteristics that we initially underwrote: durability, cash flow, and downside protection. On page 11, we've detailed out our ESG process. I'm not going to read off specific line items. This is an area where we've been consistently beefing up our emphasis over time, not only because we think ESG is important, but it's becoming a more important credit element. Businesses that are very weak from an ESG standpoint are going to tend to have worse recoveries if they have adverse impacts, if they go through a bankruptcy. Fewer people are going to want to buy them or invest in them. And so it's an area where we've been redoubling our emphasis in recent quarters. On page 12, we still think credit is where you want to be if you're looking for a fixed income return. If you look across the other asset classes, there's really incredibly low amounts of return available. Also, many of these asset classes have very high sensitivity to interest rates and significant risk of meaningful drawdown to the extent that we see a move wider at rates. On page 13, I won't speak to all of the different quadrants here, but as you can see, we're really focused all on senior secured risk. That makes sense. That's the nature of the bank loan asset class. We're invested, all of these assets will be USD assets. We do have some overseas domicile businesses that are issuing in dollars. And we use the full breadth of the rating spectrum to deliver our results. We've included some returns on page 14. They've been good short-term, they've been good long-term. We had a lot of success in the recovery coming out of the pandemic. We found consistently different stores of value, and we were very successful moving from area to area and capturing the next area where value remained. And so we had one of our largest periods of outperformance over the last year. But as you can see, over 3, 5, 7, 10 since inception, we've been consistently outperforming our benchmark. The last page I'll just touch on is the up capture, down capture, page 15. This isolates individual months, and in a month where there's a drawdown in the market overall, what was our drawdown? In the month that the market is up, what were we up? And as you can see, we make money on both sides. It's not a huge amount of outperformance on the up, not a huge amount of outperformance on the down. It doesn't need to be. Just consistently outperforming in both directions yields really nice results over the length of time. I'm going to stop there and happy to answer any questions about the firm, the team, the strategy, and the approach.
Thank you very much. Mr. Treasurer, any commentary? And then we'll turn to questions from anybody.
Well, I guess what I like is that they lose about almost half as much as anybody else as far as their bad loans. So that kind of stood out. I like people that make money and don't lose money, and these guys have the structure and the team to, I think, successfully keep rolling in that direction.
Thank you. Mr. Secretary.
Thank you, Mr. Chairman. Just a quick question for Mr. Lane. I had noted in the slide on page 12, you mentioned the high yield asset class, and I was going to ask you what challenges and opportunities you face in the current interest rate environment. Sure.
We do participate in the high yield asset class. I think the biggest challenge is that the double B part of the market, which is about half of high yield overall, a little bit more than half, is at incredibly low total yield and quite a low spread. And there's much more risk in that asset class on a significant move in treasuries today than there has been at other points in time. You just don't have enough spread to give if you get a move meaningfully higher in treasuries. We also think that it's really worth noting that the last time the Fed embarked on tapering its asset purchases in 2012, treasuries did indeed move sharply higher. So, we think that in that part of the market, there is both, there's greater exposure to treasuries moving higher. And there are some things going on in with the Fed that indicate that perhaps that risk could emerge sooner rather than later. And so that's one of the reasons why we think bank loans are which is exclusively what we would be investing in for Wyoming to the extent that we're selected. Why we think it's so attractive is because it just doesn't have that exposure to underlying treasuries.
Thank you, Mr. Chairman.
Thank you, Mr. Secretary. Madam Auditor.
No questions, Mr. Chairman.
Superintendent? Thanks. Well, great. One question I had was on your ESG scoring. You know, that's become quite a fashionable thing over the last several years and really is affecting the way investing is being done. Good on environmentalists for that. The question I guess I have would be, are there stationary metrics, or are those metrics somewhat dynamic? In particular, I guess when we look at, let's say, a renewable platform, which usually scores fairly high on ESG platforms, but there are some states that are taking natural gas, particularly methane, that's generated biogenically, and calling that a renewable. And I'm just curious how that, how that the company doing that might kind of walk through that. And then similarly, I guess with carbon capture and sequestration, are there ways that people are looking at those too, or is it just a kind of a bland screen? This looks good. It's got women on the board. There's lots of diversity. That sort of thing.
Sure. Thank you for the question, Governor. I think that as we have developed, we've been on a journey ourselves with respect to ESG investing. The first step we took was, hiring some third-party providers that provide assessments on all of these different companies. And one of the reasons why we decided to take the next step, which is have our team do our own assessment, was that we were noticing things that seemed inconsistent and seemed it didn't make sense to us. Businesses that had maybe had accounting irregularities that were getting a pass from some of these third-party providers in terms of governance. And so we've been over the past couple of quarters building out our own database of ESG assessments for all of the companies in our portfolio. And as we've done that, what we find is the devil's in the details. And really, there are a lot of businesses that are very straightforward, and you can answer the questions. And then there are the tails at either end, and you really have to dig in and ultimately make a judgment call about whether or not you think that the steps that a company is taking to remediate maybe an ESG negative are satisfactory to give them a pass or not. And we find that in a lot of these, the tricky thing is that there isn't a right answer. There isn't, it's clearly yes or it's clearly no. So I think the short answer is that there is some eye of the beholder phenomenon. I also think that there is some shift over time in terms of the types of industries that are accepted. Maybe tobacco is an area that's been out of favor for a long time. But today we see, the high yield market happy to invest in, across the energy spectrum, as an example. We have some concerns whether or not the market will be as open to the full spectrum of energy businesses in the future. And that's one of the things that's starting to inform our underwrites there. So, I'm not sure that I have a yes or no answer to your question, Governor, but that's the way that we see it. It is a devil in the details. type assessment. And, we've taken it in-house because we think that we can be more confident in our assessments if we did them ourselves. We can, at the very least, say this is why we saw it that way. And what we found with the third-party providers was we just couldn't do that.
Well, I appreciate that, and thank you for doing that, because I do think the devil really is in the details. And I say that because I can remember serving on the board of the Sierra Club back in the 1980s, and everybody's notion at that time is we can drive, if we get CalPERS, if we get enough people on CalPERS, we can drive how this investment strategy goes. But it wasn't really with the kind of sophistication that you're talking about. And so I very much appreciate what you're saying. So the other question is much simpler, and that is Ari Barkin still around KKR?
Yeah, sure is. Yep.
And just as ornery and active as ever.
Aha. Well, good. Well, a great company, and I have no further questions. Are there any other questions for anyone else? Well, board, what is your pleasure?
Well, Mr. Chairman?
Mr. Treasurer.
Yeah, I would make a motion here that the state treasurer recommends the board select KKR as the manager for the state's bank loan allocations conditioned upon successful contract negotiation.
That motion's been made by the treasurer. Is there support?
I'll second, Mr. Chairman.
I think everybody seconded it. So I'll recognize the voice. So that would have been the auditor. Okay. All in favor signify by saying aye.
Aye.
That motion carries. So Mr. Lane, I would, and thank you all for that, and congratulations, Dan, good to see you. I would really appreciate maybe an opportunity to engage on some of the ESG conversations, just because I think we're really in an interesting transitional time, and we'd love to be helpful, or at least listen a little bit to those conversations.
Absolutely, we would absolutely welcome that, and we'll follow up to figure out how to best achieve that going forward, without a doubt.
Thanks.
Thank you all. Thank you very much.
Thank you.
Congratulations.
Great, thank you.
Thank you, everyone.
Excited to partner with the state of Wyoming.
Thank you.
Excellent, thanks. Mr. Treasurer.
Well, Mr. Chairman, our next manager is up is PIMCO. We already have them doing some other things for us, and I think Josh and now Caleb, is this the one you're going to assist on then?
Mr. Treasurer, Patrick's going to give a brief introduction, and then Josh will.
Okay. I keep trying to get you up on the main stage there, buddy. Okay. All right. Okay. Patrick, I guess you can start it off, and when it's good for Josh to take over, just go ahead and tee him up there then.
Great. Thank you, Mr. Chairman, Mr. Treasurer, Patrick Fleming, CIO for the state. I apologize for not being on earlier. We had a little computer problems here. Ben and I are trying to work it out. But you know, as you know, this is just the final leg of our the introduction of the asset allocation for the September 1st filing. And I don't know if it was mentioned before, but we previously talked about both managers were unanimously voted yes on. So if that's already been stated, I apologize, but I just wanted to make sure that was put through. As we know, PIMCO has close to $3 billion under management right now in our core bond funds, and the money will be coming primarily out of that fund to fund this low duration strategy. So we've already talked about it with all of the members here. So I don't want to go into all the details, but with that, I'll pass it on to Brent Gresham and Sonali Peer, who is going to present on the PIMCO transitional portfolio. Thank you.
Excellent. Well, thank you, Patrick, Josh, and the RBK team, Governor Gordon, Treasurer Meyer, Director Scoggin, and members of the State Loan and Investment Board. We just want to say up front that it's an honor and a privilege to already be entrusted with so much with the capital state of Wyoming. And we're deeply appreciative of the opportunity to potentially partner with you and expand our relationship to this new mandate. I've been at PIMCO for almost 5 years, working with Wyoming for the bulk of that time, and the relationship itself dates back to 15 years plus. So very excited to be having this conversation. I've met some of you previously at annual conferences past, but just by way of brief introduction or reintroduction, as I mentioned, my name is Brent Gresham. I've been at PIMCO for since 2016 on the client coverage team. Prior to joining PIMCO, I was a pilot in the U.S. Navy for about 10 years. So, Lisa, I very much appreciate your support of Vietnam veterans and their artwork. I'm also joined by my colleague Sonali Peer, who has been at PIMCO since 2013. She's a partner at the firm, and she co-leads our multi-sector credit platform. She was also recently named by Morningstar one of their 2021 Investing Excellence Award winners for Rising Talent. And I think most importantly for today's conversation, she was really instrumental along with her team of putting this proposal forward that you see before you. And should we be fortunate enough to partner together, she will be your lead portfolio manager for this account. Before I turn the floor to Sonali to talk through the portfolio, I thought it might be helpful to just sort of summarize up front what it is that we think we can deliver for the state of Wyoming with this new mandate, which is namely a high quality, low duration multi-sector credit portfolio that takes equally seriously liquidity and downside protection, as well as the potential for excess return. And one way you'll be able to see that later on with Sonali's comments is that while the model portfolio that she and her team put together does out yield the benchmark, it does so with higher quality and lower modeled expected volatility. So with that as context, I'll turn the floor to my colleague Sonali to talk through a little bit about our multi-sector team, the process itself, and then finally portfolio construction in the current environment. And I'll take our cues from KKR as far as perhaps just referencing the slides and material that you have before you rather than sharing my screen.
Great. Again, thank you for the opportunity and the trust in our abilities. We're very excited about the opportunity to partner with all of you. I'll just take us to the first slide, which has the team, and I'll briefly mention who is involved in multi-sector credit mandates and the rationale. So Dan Ivison, our group CIO of the firm, is firmly involved in many of the multi-sector mandates, and mainly because it does cross a number of asset classes, and that coordination that's needed to be successful across asset classes is something that he takes very seriously and is interested in. And so similar to his income fund, multi-sector credit is coordinated in such fashion that myself, Alfred Murata, who's one of the co-leads in the income fund as well, Yves Tournier, based in London, and myself are coordinating with the various specialty desks. So in this case, with specialists in CLOs, which specialists in investment grade, as well as in high yield and potentially even EM, to source those best risk-adjusted ideas across the global market. And the reason it comes together at we're really trying to marry the thought leadership from PIMCO from the top down, from the investment committee, our quarterly forums. Our investment committee, for example, meets 2 hours a day, 4 days a week. Our quarterly forum process, 3 times a year, we're looking on a cyclical basis to discuss the different each of the different product asset classes and where we think they're going over a 6 to 12 month period. And once we do this on a secular basis, so really looking for outside speakers to make sure we're avoiding things like groupthink, and we're really thinking about what's going to challenge the market over the next 3 to 5 years. And our PM team kind of sits in the middle of all those top-down processes married with the bottoms-up. So our credit research analysts, we have about 75 globally, and they're looking through where they're interacting with management teams. They're in a non-COVID year at facilities and really trying to do the due diligence to understand the drivers on a forward-looking basis for any one of these individual credits. On that note, many times our relationships are such that we can help find a solution for the issuer, as well as find a attractive investment opportunity for our portfolios on behalf of our clients. It's the desks below there that you see on the various asset classes. You can see this is very much a strategy that relies on a broad team, and as a result, we have many different touch points with each of these areas to make sure we're able to source the best ideas that should make it into this portfolio, for example. In the earlier presentation we had included one of our CLO specialists, Brian Sue, as well as one of our investment grade specialists, Amit Arora, who would work with me to source these ideas into the portfolio. On the following page, we just highlight some of the investment themes that we're looking to capture. And just to be brief, I'll highlight some of the areas that we're finding attractive in the market today, such as financials, which historically pre-great financial crisis have been quite levered, and in part due to regulation has led to a significant amount of issuance and a much lower leverage profile and much better credit metrics today. We have a team just for financials of 8 global analysts that are looking across the capital structure from senior all the way down to more of your structured bank capital for ideas across the globe. We've looked at areas in high yield that are up, we call it up in quality here, where the cash flows are more predictable than, say, you would find in energy exploration and production, for example. So looking at industries like media and cable. We're also selectively looking at COVID exposure. And I say selectively here because rather than, admittedly, we've recovered quite a bit since the Fed had stepped in last year in credit markets. However, we think there's still some room for spread compression in COVID sectors such as leisure, travel. However, we say selectively because, in the past, we want to do this in a much more downside protection, resilient fashion, meaning, if we look at airlines, for example, rather than purchasing unsecured debt, which, historically has had very low recoveries when they do get in trouble, even with the, the money they've gotten from the government over this past year, it's very important that we are protecting your capital from the downside. And so rather we would look at WTCs, which are actually backed by the airplane itself, or engines or spare parts, or mileage deals, or route slots and gates. So something with hard collateral or collateral that can be tested in bankruptcy and resold, as opposed to, taking a capital loss. And then a couple other areas, we looked at some areas within Asian credit as well as non-agency mortgages, which really highlight, again, that downside protection, because non-agency mortgages, again, that hard collateral, as well as, it incorporates our view for housing price appreciation and improvement in the lender itself, the borrower. What we are trying to avoid, and you can probably sense from some of my comments on even the COVID sectors, is vulnerable high yield. So, cyclicals that don't have a downside protection that we can truly count on, whether that's due to high level of cyclicality or that's due to very loose covenants, such that, we could assume if the issuer were in trouble, they would continue to either sell assets or issue additional debt, and thereby, reducing our coverage. Other areas that we're worried about are, areas where, our view for example, for developed markets, GDP growth is for about 6% this year, and for EM to lag. However, over the next, call it by the second half of next year, as vaccine rates in the emerging markets pick up and, there's some opportunity potentially in time, but clearly at this stage, developed markets are outperforming emerging markets. And so we've been very selective within EM. And then lastly, and I think you heard this from the previous presentation, just the fact that absolute spread levels are relatively tight. And so, where we don't feel we're getting compensated from a valuation perspective for the risk, that, if it's a very tight and asymmetric, we would like to avoid that type of investment. What we're watching, is the evolution certainly of the various variants, COVID vaccine rates, especially in emerging markets. And then certainly the monetary and fiscal response. Recently, of course, we've had additional infrastructure spend, but the monetary policy will be, our expectations is that the Fed will announce a tapering of some of their asset purchases at the next meeting and for it to commence in January of 2022. However, no rate hike until 2023. On the following page, we've provided our model portfolio, or the page after that, for this mandate. And this is what Brant was referring to in terms of, if you look at the yield to worst over the estimated vol, the portfolio has a higher Sharpe ratio than the benchmark itself. And so meaning, again, highlighting that we wanted to be very mindful of the volatility and protect on the downside while keeping up on the upside. We have a slightly higher quality rating for the model portfolio than we do for the benchmark itself. So some of the ways in which we've achieved this is that we have looked at higher quality portions of the CLO market than the benchmark itself. And on the next page, and just I wanted to highlight too that the model encompasses a bit more diversification, as you can see from that bottom right bar chart, in terms of asset classes. And as a result, I think that also helps minimize some of the volatility versus the benchmark. Again, diversification often helps on that topic. On the following page, you'll see why we had limited our CLOs to higher quality CLOs. As you go, even though it's investment grade rated, those triple Bs, as you go lower in quality, the downside is much less forgiving. And this is something where, we believe in the higher quality parts that you're shorter dated, more static type CLO than ones that are either longer dated, lower quality, and allow for more manager substitution of those underlying loans. Within investment grade, the themes are similar to what we're looking at within high yield. So, some of the COVID sectors where we feel we're getting adequately compensated, and we can measure if let's say a variant were to sustain itself for longer than expected, what that downside protection would look like. And then lastly, within high yield, one area over the next 18 months that we think provides some opportunity is rising stars. After we had 200 billion of fallen angels last year, the expectation is that we actually have credits that are improving alongside a strong outlook for GDP as well as corporate earnings, such that some of these high yield companies may make their way back to investment grade and provide a spread tightening catalyst that way. On the following page, we've provided a little bit more of a breakdown for how we're achieving the model portfolio versus the benchmark's volatility contribution, and why it's lower in the model versus in the representative benchmark, and how we are still keeping up on a spread basis to outperform that benchmark. Part of the way, one of the ways in which we've achieved this is we've added a little bit of duration. So we've gone slightly longer than the benchmark, however, still within the constraints provided, which were to be below 1.5 years of duration. And lastly, we're very mindful of the fact that this money is earmarked for ideally private credit investment down the line. I know my colleague Jamie Weinstein will be meeting with all of you in about a week's time, which is why we've provided on page 11 historical scenario analysis, meaning we want to make sure that you have access to that capital when you need it, and that the downside has a bit more resilience than even the high quality benchmark that has been selected. So on page 11, you can see a couple scenarios where rates rise or when spreads widen, how the portfolio will outperform on a historical basis. Of course, I can't show you on a forward-looking basis just yet, versus the benchmark itself.
Great, thanks, Sonali. Maybe I'll briefly just close by saying that we think as PIMCO, we can be a truly effective partner to the state of Wyoming in building out this new element of your strategic asset allocation. We very much appreciate the opportunity to present today and to be considered, and happy to answer any questions at this time.
Mr. Treasurer.
No questions, Mr. Chairman.
Mr. Secretary.
No questions, Mr. Chairman. Thank you.
Madam Auditor.
No questions, Mr. Chairman.
Madam Superintendent. She stepped away. I don't have any questions. I thank you very much. I have a question after we vote, which would be fairly straightforward. So, Mr. Treasurer, would you like to make the motion?
Yeah, Mr. Chairman. I think PIMCO is a solid company with solid returns, and from that, I guess, point of view, I would recommend that the board select PIMCO as a manager for the state's transition low duration fixed income allocations, conditioned upon successful contract negotiations.
Thank you, Mr. Treasurer, for the motion. Is there a second? The second from the superintendent, I think. Is that correct, Superintendent? You're muted. Oh, okay. I got a second from the secretary. Thank you. All in favor signify with an eye or a thumbs up.
Aye.
I have thumbs up across the spectrum here and ayes. That is unanimous, as was the other. Madam Director, thank you. That motion carries. The question I had for the PIMCO folks is, how was this process of manager selection for you? Just curious. You've met with us. You've met with the Investment Funds Committee, with a crew that is in the Treasurer's office, and also with RBK.
Sure, I can answer that. I thought it was quite efficient. I think I usually think in relative terms, and it's certainly true that I work with a lot of entities that, from a manager selection perspective, the process can be play out on a longer time horizon, through various I guess issues and constraints that I'm sure many of you are familiar with. In terms of, if I think back to the moment when Patrick and his team sort of talked about this idea to us submitting a proposal and making this presentation today, I would say it was incredibly efficient on a relative basis, and probably about as efficient as PIMCO could handle it. I know that Patrick and Caleb were always pushing us to deliver at high quality on a short timeline. So it was an absolute pleasure from our perspective. I don't have any suggestions for improvements to the process.
I would add that I thought also their questions were very thoughtful and thorough as well.
Well, thank you both. Congratulations to your team, Patrick, and Mr. Treasurer, thank you for, I think we're on a path here that is helping the process. So thanks for your leadership on that.
Yeah. Well, Mr. Chairman, you know, it's, I guess kudos to all of the people on the team. They step up, they do a good job, and it's good to hear back from the responses of your question from PIMCO that the questions and the process was thorough. We hope to do our due diligence as much as we possibly can. And of course, PIMCO was a fairly easy one because you guys do a lot of work for us already, you know, so maybe that's why it was so efficient. Some of the other managers might not be quite as lucky as you guys, because we know you pretty well and you've been doing jobs for us for a long time. And I thank you guys for picking this up. I think you'll do a good job with this low duration product.
Thank you for the trust and partnership. It's much appreciated.
Absolutely. Thank you so much.
Thank you. Congratulations. Madam Director, is there anything more that we need to worry about?
Mr. Chairman, I think that concludes the agenda for the special meeting today.
Thanks very much. All right. Well, I would entertain a motion to adjourn.
Move to adjourn, Mr. Chairman.
It's been moved. Is there a second?
Second.
It's been seconded by the auditor. All in favor signify with a thumbs up or an eye.
Aye.
Thanks very much. And talk to you later. Thanks again.